Okay, hello everyone. I'm gonna tonight talk about low risk stock setups and what does that really mean. I'm gonna build on the PDF that I shared with you guys a few weeks back. Really appreciate your support for the folks who did. Very small number of you, and that's okay. I'm not trying to get rich out of these. I'm trying to help people that are serious about learning and growing in their trading. So what I'm gonna do is I'm gonna provide more value to that PDF, and I'm gonna do this video with the same PDF because it's not about doing more PDFs. It's about adding to that PDF. So I'm gonna use the same chart setup. So if you did get that PDF a few weeks back, then pull it up, grab a pen, and there's gonna be a lot of annotations that you're going to be able to do to add to that learning experience from that PDF and from those setups. That's the idea. And then if you're one of the folks that have not gotten the PDF, let's jump in here to the next slide. You're going to be able to get the PDF. I will put the link in the description. Again, it's a small price for if you would like to support me. Otherwise, you can go and make your own PDF. It's going to take you about an hour or so to get that put all together and whatnot. So if you'd rather do that, then go ahead. If you decide to use the Cash app, I discovered that from last time. I can't send you the link. I can't chat with you. So please, if you decide to use the Cash app, make sure in your description when you're sending the $8.50, make sure to put your email address so I can reply back and send you the link for the PDF. All right. Stripe is the easiest one because as soon as you use Stripe, you'll get the link to the PDF automatically. You don't have to wait for me if I'm asleep or away or not paying attention to my phone. For Venmo and Cash App, you'll have to wait for me to get the URL for you. For Stripe, again, I will link to the PDF. Appreciate your support if you decided to. Again, very small amount of you that has, and I really appreciate it. Some of you reach out to me, thanking me and asking for more PDFs. So we'll see. But for right now, I'm going to use the same PDF. So grab your PDF if hopefully you printed it, and then grab your pen and let's dive in. So we're going to talk about what is really a low risk entry. Before we start, disclaimer: this is do your own homework, your own due diligence. This is not a recommendation to buy, hold, or sell any of the stocks and securities that you see today. All right. So with that out of the way, let's dive into, let me show the PDF quickly for folks who does not have it. Again, high quality PDF, 41 pages, tons of setups in it before the stock made its move, and then after the stock made its move. So I'll put the link in the description again, but we're going to go through these, not all of them because that's going to get really long, but I want to make few points, and I'm going to use about 6 or 7 setups from this PDF to help you out and try to explain a few things and hopefully get you to see what low risk entry means. What I want to do first, I'm going to go back to the slide, and then I'm going to take you to Kindle. And we're going to look at a couple paragraphs from Mark Minervini's book, Think and Trade Like a Champion. This is his second book that he wrote. And sorry, guys, I'm under the weather a little bit, so I'm going to I have a cup of tea in front of me. So I'm probably going to be drinking some tea just to keep my throat preventing it from drying. It's been a rough couple of days. So if I'm quiet a little bit, I'm sipping my tea. So I wanted to really set the stage as to what we're going to be talking about and what do we mean by low risk entry. And I want to start reading a couple paragraphs from Mark Minervini's book. I've read this book countless times, honestly, lost count. But those 2 paragraphs set the stage to how I approach trading. I didn't invent stuff. I studied successful traders like Mark, like Bill, like Stan. And then I took them and made their approaches, their teaching, my own. and I tweaked some of it a little bit. I didn't copycat exactly the same thing. You guys will see what I mean by that here in a few minutes when we start looking at the charts and then examples, okay? But let's start with backing into risk. If you've watched some of Mark Minervini's interviews, you hear him talk about this sometimes. So I'm going to read the paragraph, and then we're going to jump into a couple concepts here from his book. It's just a couple pages. So let's read that, because that sets the stage, and he obviously explains it better, more than I can. So backing into risk. My stop loss is actually an important part of my selection process. So this is very important. His stop loss is an important part of his selection process. I may set my sights on a particular name, but I'm not going to buy a stock unless it offers me a low risk entry. Very important. You guys hear me say on X, Twitter, I'm waiting, right? That is a tight stop loss is part of my selection criteria. If the stock doesn't set up a tight low risk entry, I won't take it. You don't control risk when you sell, you control it when you buy. When you sell, you simply take the loss, but the loss should already be predetermined, and it should make mathematical sense. Can you afford to take 25% loss if your expected gain is only 10% or 15%? Obviously, no. If you consistently buy stocks with more reward than risk, over time, you're going to be in good shape because you will have an edge. But if you stack the odds against yourself and risk more than you stand to gain, you might as well go to the casino, right? So your stop is part of your selection criteria. That is the takeaway from this paragraph. The second piece that's extremely important is trading near the danger point. Absolutely shaped how I trade. And let me explain what that means. To control my risk, I want to enter my buy as close to my stop as possible. There's a difference between choking a trade and then placing a tight stop when you're trading near the danger point. And I'll go into the examples. Again, there's a difference between choking a stock because you're buying it extended, or putting a tight stop because you're buying the stock close to the danger point. This is known as trading close to the danger point. Figure 2.1. We'll get to the figure here. Stock broke out, it's pulling back, and then he's buying it, turning back up right here, right? So he's buying here, turning back up, and the danger level is down here. Now, this is a little bit wide. I don't know what this is, but I'll show you examples. But he is buying it into a place where he's expecting the natural reaction here to complete and round back up. So he's trading, he's not buying it up here. Buying it up here is not near the danger point. Buying it down here, turning up, is close to the danger point. So I'll explain here a little bit. Distinguishing normal behavior from abnormal is an important skill that you should spend time developing. Buying breakouts and setting stops based on a percentage drop is a good start. Obviously, controlling risk is a good start, and it will likely put you ahead of most traders. However, the really great traders know how to discern proper price action from dangerous price action, and they place trades close to the point at which a stock flashes warnings and the trade sours. Go back and read this multiple times. It's what I'm going to try to explain in the examples. They place trades close to the point at which a stock flashes warning and the trade sours. Remember that, all right? The goal for optimal stop loss placement is to set it at a level that will allow the stock price enough room for normal fluctuation, but close enough to the danger point that's not too much risk mathematically. Smart traders set stops based on underlying technical action in line with the reality of their prevailing arithmetic. Trading near the danger point means trading low risk entries. Again, one more time. trading near the danger point means trading low risk entries. Very important. So let me jump in. Just remember this line, and I'm going to jump into examples, and then start. Hopefully, that will start making sense to you. All right. So we are going to start with F and D. Again, these setups are in the PDF. Appreciate your support if you want the PDF. So let's start with this one. I am going to start with this one here, and then talk about how is this trading near the danger point. Okay. Well, you gotta take a look at what's happening. So here's uptrend. Here's your pullback. This is breaking the trend line and then going sideways. Okay. In my view, the danger point is where you are expecting the stock, for specific reasons, that it is going to turn up and start moving. Okay. In this setup here, this is it broke the downtrend. Okay, breaking the downtrend. I'll do that here. Breaking the downtrend, going up with lots of volume, pocket pivots, new high before price, multiple 1, 2, 3, 4, 5, 6, new high before price, pulling back. This is a mini pullback buy, up, pull back, up, buy it here. Okay, so what am I expecting? I'm expecting as soon as this turns around, this is my danger point right here. Okay, so if I'm buying it coming out of here, I have the 21 EMA, I have the 50 MA, and I have a break of a downtrend and a turn back up. I have multiple reasons to believe that this is the low, and that if the stock start turning up, it should not drop below this low. That is my danger point. Okay, and that is 4%. Okay, so that is my danger point in this setup. Now let's go to the next setup, and you need to be able to identify that danger point and trade right next to it, right close to it, like Mark Minervini explained in his example. In his example, he explained it pulling back to the top of the base, but that's not the only way you can trade next to the danger point. So I'm going to show you, those are the examples I'm going to show you how to trade next to the danger point. So what do we see now? We see contractions, right? So we see 1, 2, 3. Another way to look at this, breakout. So you broke out, you're pulling back. Okay. Another way you see this, cup with handle. It doesn't matter, right? They're all saying the same thing. They're all saying this stock is being accumulated. Whether it's wave 1, wave 2, wave 3, whether it's breakout, pulling back to support, whether it's cup with handle, it's all saying the same thing. Stock is being accumulated in the base. So if we're going to treat this as breakout and pull back to support, that is doing what? You are trying to take the stock when it turns back up, right here, turn back up. You are buying that right next to the danger point. What do you see right next to the danger point? Why is this the danger point? There's your breakout support. There's your 21 EMA. There's your 50 MA. If you buy it here and the stock drops below this, what does that mean? That means your thesis is wrong. That means this danger point that allowed you to take a tight stop loss. What is this stop loss? Let's grab this tool. The stop loss, 3%. And you'll be out. All right. So that's danger point. Okay. Let's do that. Danger point. Okay. Danger point. Okay. Now, stock, you buy it here, runs up, breaks out of this base, right? This is the red line that you see. And now it does what? Pulls back. Mark Minervini's example is very close to this one. It's pulling back. Do you buy it? Did Mark buy it? Let me go back here. Did Mark buy it pulling back blindly? No. He bought it turning back up. I'm buying here, turning back up, right? Taking the highs of these candles or bars and turning back up, okay? So let's apply that. Let's apply that here, okay? So the stock pulls back and then goes inside, meaning what? Finding support, pulls back on what? Low volume. So what are you expecting? The stock to start turning back up. As soon as the stock turns back up, then you buy it. And what's your stop? 2.5%, 2.8%. This is your danger point. I'm not sure where this is your danger point, right? So tight stop, not choking the trade. Tight stop, not choking the trade, because you're trading near the danger point, right? So I think this is a really good example. Some of you might say, well, okay, well, why don't you buy this, right? Okay, pulling back to the 50 in the 10-week MA and the 50. But look at the difference. How this pulled back. Look at this comes with experience. What do you see here when this pulled back? No red bars. And what do you see with the 21 EMA trending up? When this pulled back here, 21 EMA up, no red. When this pulled back to the top of the base, what do you see? 21 EMA up. When this and no red, right? When this slammed on earning, warning number 1, high volume, red. Warning number 2, 21 MA down. So a lot of differences. And then you've got this big gap. And the stock never tied up. What do you want to buy it here? It's not tight enough. So this is nothing like this, nothing like this, nothing like this. So hopefully you got a lot of annotations. You need to watch this back multiple times and write these down. Write them down. All right, next one. Let's do LSCC from the PDF. Again, let's go back to the PDF. Here's LSCC. All right. Why is this a good setup and why is this a low risk entry? All right, well, let's take a look at this. Big base right here, you can say, right? It's just taken out all this consolidation, really strong, going on pocket pivot after pocket pivot, very strong. And what do you see it doing? Pulling back. It's pulling back. Not even one single red bar. Okay, so pulling back, very orderly, and looks good. And now testing the 50 first time after it breaks out of this big base. So that's high probability trade. That means what? That means you're trading near the danger zone. You let it fall and then try to stabilize. No higher high, no higher high, no higher high, no higher high until right here. Do you buy it right away? You don't have to. You can if you want to. You could have bought it here. If you're, want the stock pretty badly, but there's still a lot of time here. This is just the first higher high, right? So let's zoom in here a little bit. This is your first higher high from this candle throughout this drop. Well, there's a higher high here, but I think this is just too early. So you're testing the 50, and then you just create this clear supply line here. You've got your mini coil, 2 bars inside of 1 bar. So now what's happening now? Price is consolidating on low volume. What does that mean? Right at the 50, right at the 10-week MA, right? And then you do have your 21 MA falling down, but then right over here it turns around, right? But there's no red. That's very, very important. That means there's no selling, okay? This is just going down because the market is going down. And as soon as the market turned around, this stock turned around and made the turn. This is your danger point, okay? So you're buying this, turning around, coming back out. And what's your stop? 5%, right? This is a little bit, I mean, if this is your 2 bars instead of 1 bar, this is your consolidation. If it goes below that consolidation, that means you essentially need to be out. Your thesis is wrong. We're not done falling down. Okay, so 5-6%. For a stock that really moves, right? So you're risking 5% and you're making 40%, right? So, all right. So this is number 2. Let's do GLBE. Hopefully you guys starting to see what I'm trying to show you. Let's do GLBE here. Where's the setup? The setup is right here. So again, if you go to the PDF and you scroll down to the right one, I skipped few because I wanted to show you guys good examples. ALGM I skipped. So this is the GLBE, and then here's the entries, right? So let's talk about that. All right. So sorry guys, I'm gonna get some tea. All right. So the buy was here, the buy was here, and then another buy was here. I'm going to talk about this buy. I'm going to talk about this buy. Why are these near the danger zone? Well, let's talk about this one here. Stock jolted higher, pull back, and then went up. You buy it here. Okay. Why is this low risk entry? Well, up on high volume, pocket pivots, right? Pulling back gently, no red, turning around. Okay. Where is it pulling back to? Uptrending 21 EMA, 10-week MA, and 50. Okay. So I am taking this trade as a pullback buy. I am saying this is my low because look, what do I have here? I have, let me remove this, and remove this. I've got 21 EMA. I've got the 10-week. I've got the 50. My thesis is this is the low. I'm going to buy it, turn it around. And if it fails, then what's my stop? My thesis is wrong if the low of this bar gets broken, and that is 4%. Okay. Now, some of you might say, okay, well, why didn't we, I don't know, why didn't we buy it here? Let's just, I mean, there's no pullback buy here, but let's just say this is tight, okay? Let's just say this is tight. You bought it here. You know, you're gonna say, hey, TA, why aren't we buying it here, right? Okay, well, let's take a look at that piece a little bit. So you could potentially say, okay, this is going up, pulling back. I want to buy it, turn it back around, right? Makes sense. Fine, we can do that. But look at the difference. What do you see here? Lots of red. Where is this red? All of it here. This setup is still having red here. And then you have wide range bar. This setup is too close to this selling. Too close to this selling. Look at the difference here when this set up again. Look what happened here. Extreme volume dry up, no selling, no red. That means this is now far away from the selling. This setup here is far away from the selling. That's why this is a higher probability trade than this. That's why I won't be looking at these. You need to be patient and then let the stock set up. Okay, so that's why this is trading in the danger zone. And now this is obviously very obvious. Breaks out. This is a big base. Breaks out, pulls back beautifully, pulls back on extremely low volume. This is January here. It's not December for low volume. It's January. It's June. So pulls back. This is 21 EMA, previous base, and then you buy it coming out here with a stop of 5% on a stock that moves pretty fast. Danger zone, right? Danger point. Danger point. Okay? Danger point. Right? So hopefully that's making more and more sense with more examples. Let's do YPF. Grab the pens, annotate. This is the buy coming out here. Okay. Why is this danger point? Why is this trading close to the danger point? Well, you've got head and shoulder continuation pattern. This is your shoulder. This is what's in your head. You're saying this is the shoulder. What does that mean? Right? That means that's my danger point right here. Right? So I'm trading right here. I'm trying to find an entry, and my danger point is right here because I am thinking that this is the right shoulder and the low should not be broken. So if I'm buying this coming out, that's 5%. Okay. Down here, all the way down here is 8%. It's pretty deep. I wouldn't be doing that. So that's why this is near the danger point, because I'm in my head, I'm thinking this is the right shoulder of head and shoulder continuation. So I'm going to try to find an entry here, and it's, what do you see here, right? It's away from the red, right? That's why this is set up right here. Okay. All right. So let's do one more IBKR. I'll go through these a little bit quickly. This is one of this. I bought it here. You guys remember, bought it here, bought it here, bought it here. But I'm going to talk about this one here. How is that near the danger zone? Well, I am... if you guys saw when I talked about this setup, this is the earning, and then goes really tight. No selling, very tight. What am I doing with this? My assumption is that this here holds because 1, 2, 3, very tight after earning, all 3 bars inside of this bar. So your danger point is right here potentially, right? So if you want to take that right here and then put it all the way down, that's 3%. If you want to put it below this, that is 1.6%, extremely tight. And it's, where is this happening, right? It's happening 21 EMA, turning back up, 10-week MA, and you go. So this danger point right here, right? So that's why this is a danger point. Let me see here. WWD. Where's the danger point on this? This is, I bought this one here and I added to it here. Well, the danger point is essentially this, right? So this is your low for the gap, and then you have your shakeout over here, and then the stock turns around. So undercut and rally, right? You see that a lot on Twitter. A lot of people trade undercuts and rallies. I don't, because I work all day long, so I can't sit and watch stocks for undercuts and rallies. It's really hard to, almost impossible to plan your trades the night before with stop limits for undercuts and rallies, right? So I choose styles and strategies that fit my life, not the other way around. But I know these strategies, and I know how to use them to my own advantage, because I'm not trying to buy the absolute bottom. But when you have this undercut and rally, the stock then gives you a mini coil, right? And then now you're buying it here, and then your danger point is either here or here, depending on really how tight you want to be. So if you want to be really tight, then you're doing 2.4, 2.3. If you want to be a little looser, you're doing 5.6%. And that giving the stock all the way down to that danger point. Your undercut and rally is now your danger point. If the stock does this, you want to be out. But my stop was down here. Why? Because I like tight stops, but it's still not choking the trade. But I am willing to get back in if I get stopped out, right? So that's extremely important. If you're someone who does not know how to get back in, you want to give it the wider stop, and that's still 5%. It's not a big deal. All right, SHAK. Let's do SHAK and talk about why is this a danger point right here. Here's the entry. Here's the entry. Well, this is your kind of breakout out of the base. On earning, big volume, and then you're testing that 21 EMA for the first time. You got a couple of tails right here, hammer, another hammer, support, and then stock tightening up, and then gives you clear supply line. So if you buy it turning around and turning back up, this is your danger point. If the stock comes back in and drops below this point, you need to be out. You are trading near the danger point. You're not buying it here. That is not trading next to the danger point. That is normal for the stock to do this and still looks extremely good. But when the stock does this, that's not normal. That means it's going to go all the way down to the 50 and it will be out. So this is a danger zone. This is a danger point. There's no danger point here. This is extended stock after a gap up. And this is just a slight pullback on very, 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 very low volume right here. Very tight. And then you're buying it, turning back up to the previous area that was support now. So you're trading next to the danger point, and then you sell if we break down here. Okay. All right. One more. This is one that I bought. ARRY. You guys know about this one. Massive volume on earning, and look at where the stock is now. Pretty beat up. But let's take a look at why were these trading near the danger zone and why these were low risk entries. So stock pulls back, nothing alarming from a volume perspective, low volume, and then it goes tight for 2 days. Well, it held the 21, the 50, the 200, held the 20, the 50, the 200, and then they tried to gap it down, right? Try to gap it down, and then bought it all day, and then goes tight 2 days inside one bar, and then it turns around and comes out. Where's your danger point? Right here, right? So what is that? Let me just delete this piece here. That is pretty tight. I mean, if you bought it here and then you put it all the way down, it's 6% on a stock that really moves. I mean, Array moves. But I think I put my stop below this one here, so that was 4%. And then this is beautiful pullback to the that you see here my line here. So this is previous level, and then you see how it undercut it just a little bit, went really, really, really tight. Look at the volume pulling back. Look at the volume pulling back. There's no volume, no red, and then turns around, and that's your danger point. You're just very tight, very nice. I played this, just nailed this one, and then I think I sold right here, all of it, or something like that. All right, so that's Array. LU is back from 2010, also from the PDF. All these examples are in the PDF. So let's go to 2010. Sorry, my throat is starting to hurt here. All right, 2010. What I like about this, this is why I put this on here. So you have your base building, and then you're still really inside of the base here, and then you get the stock goes tight. Here's what I like about this one. Extremely volume tri-up, and this is November, October timeframe. Goes really, really tight, and then you buy it coming out right here. What is your assumption, right? Your assumption is that you're buying right near the danger point. You got the 10-week MA, you got that 21 EMA tighten around these areas, and then you come out. If you're looking at this, you'll be like, okay, well, TA, why didn't we buy it, here, turn it around? Well, let's take a look at the structure with it here, because you're seeing a tight candle here. Be like, okay, well, I'm gonna buy this high. Fine, you wanna do it that way, you can, and it worked this way, because if you bought it here, turning back up, right here, then you should still be in the trade and it worked. But I don't do that. Why? Well, very simple. Look how the stock pulled back. Right? You want to buy a stock pulling back with 1, 2, 3, 4, 5 bars that has selling higher than average. That's why the stock had to tighten up. Look at the difference here. Look at the difference here. This is why this is a better setup than this setup. High probability setup. There's no better and not better. They all could fail, but you want to have the high probability setup. This setup have less probability to succeed than this setup because of your volume. Tells you no selling is left. All right. Okay. So this is really good example to show you the difference. Just few days makes a difference. And what does that mean? That means you could miss it. The stock could just do this and go, and you could miss it, and that's fine. You need to be okay with that. Because if you keep chasing stocks that pull back on heavy volume, you're ultimately going to lose your shirt. You're not going to be able to make money. So patient discipline works. FOMO doesn't work. All right, last one, an FLX. I think that was from 2010. It's also in the PDF. Let's go back over to here and then take a look at that quickly. All right, so I wanted to put this on here because again, building a base, very nice. And then here's where you could say, hey, TA, I know you say we should buy it here, and that would have worked, right? This is a pullback buy, up, pullback, and you buy it here. It's fine. So that worked. But some of you might say, well, TA, up, pullback, up. If I bought it here, I would have stepped out. Yes, potentially. And you could buy it here. This pulled back on really low volume. So if you're looking at this live, it looks like this. It looks pretty nice. There was some warning signals that this might not work because of the shadows. So that means there are still sellers coming in and selling the stock. But yeah, you could have. But here's the thing. So what? If you're going to be playing near the danger zone, you have an advantage. So let's say you bought it here and your stop is below for 3.5, 3.3%. Fine, you get stopped down. And then it did what? After it stopped you out, it set up even better. So now it pulled back all the way to the 50, all the way to the 10 week. And then it turn around and puts in a nice pivot here. Then you can trade against, and then you take the trade here, right? So now your new stop is 3%, 3.5, and then you're up 35%. So yeah, you could have stopped out here, but that doesn't matter. You're playing near the danger zone. If you know how to do this correctly, you're gonna be able to take a couple of stabs at the stock, and sometimes 3, depending on how tight that is. So hopefully that helped. I think we've covered tons. It's coming up on 40 minutes here. Time flies when you're talking stocks. Thank you. I appreciate it for folks who did download the PDF and supported my work. I appreciate it. I have no service, nothing to sell you. Trying to help. So if you like this one with the low risk entries, the link I'll put that in the description. And I appreciate your support. If you have any other ideas on other PDFs, I might do some model stocks and make them available for you guys, but that's gonna take some time and not right now. But hopefully you guys enjoyed this. Leave a comment and then share, subscribe, and share the links for the videos. It really helps. Takes time and preparation on my end. Appreciate it, and I'll talk to you guys later. Thank you.